The Fed is in a debt trap. Gold is no longer a safe haven trade. Probably never was a safe haven trade after Warsh stood up there and talked about how they were going to be so hawkish. That tells me that it was all performative, that it was all pre-approved. Each one of these cycles erodes the credibility of the dollar and other fiat currencies. Eventually, the only way to restore that credibility, I believe, is to reattach these currencies some way to...
Special coverage from the floor of the World Symposium is brought to you by Palisades Gold. Our next guest says America has entered a debt trap. What does this mean? How will this impact not just our economy, but our entire way of life? And as investors, what can we do to protect ourselves from this trap? Brien Lundin joins us once more. He is the editor of the Gold newsletter and the host of the New Orleans Investment Conference. Great conference. Check it out, link down below, and check out the Gold newsletter. Brian's going to give us his outlook on not just gold, but how our economy is going to reshape itself after this reset that he's talking about has started. This video is sponsored by Kalshi. It's the largest prediction market in the United States. Unlike a sportsbook, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below or scan the QR code here to get started and use my code LIN, L-I-N. New users who use my code can get up to $500 if you trade $25. This is CFTC approved and available in all 50 states, including California and Texas. And right now, traders are predicting that there's going to be a 99% chance that after the July FOMC meeting, the Fed is going to raise rates above 350 basis points. Well, what does Brien Lundin think? Let's find out. And he's going to tell us what happens to gold and other assets once the Fed does raise rates, if they do. If you're in the camp that believes that they will raise rates above 375, and if you put $50 down on that trade, your payout could be $197 if you turn out to be right. Welcome back to the show, Brien. Good to see you.
Thanks, David. Always a pleasure to talk with you.
Brien, let me just start with, I think, my biggest concern with the precious metals market. Every single bull rally in the gold space that has preceded us before, 1980, 2001, 2020, arguably we can count that as an extension of this current bull rally. Every single time it's happened before, we had a mega rally spanning years or decades. Gold has corrected immediately after, didn't stay at its high, and then we had a multi-year low. Now, this time is different is one of the most dangerous phrases in the financial lexicon. But why would this time be any different than, let's say, 1980 or 2011?
Yeah, you're right. That is the most dangerous phrase in investing. But every time is different to some degree. History doesn't repeat exactly, it rhymes. Every bull market follows its own path and details in the details, and the devil's in the details. But broadly speaking, we have the same big patterns that emerge. But this market is different than any one we've ever had before, and for good reasons. It started because we had central banks buying gold hand over fist. And that really gave us a big advantage because central banks don't buy mining stocks. They don't buy silver. These are the traditional levers to a gold bull market. And so those assets remained kind of in the doldrums. They remained at really historically low levels, even as the risk of whether there was going to be a gold bull market was solved for. So gold was taking off, the mining stocks lagged, silver lagged, so we had a lot of time to invest in these levers at really low levels, and hopefully a lot of us did. Now that's changed. We are in more of a typical gold bull market, one that's driven by Western investors, and in this case, Western traders, and more specifically, algos that are trading the market on a very hot money basis, as it were. So that means we get tremendous rallies, we get, big drops, we get the kind of volatility that is normal for a bull market, but which we were, really enjoyed the fact that we didn't have that kind of volatility for the first 18 months of this bull run.
I like to talk about the influence of interest rates on the gold price. So currently the Fed funds rate stands at 350 to 375 basis points. Now look at this. This is the prediction market from Cauchy, and I like to use prediction markets because they've been pretty accurate the closer you get to the actual event. This is Fed funds rate after July meeting. Now we're speaking on the 28th of July, Brian, the day before the FOMC meeting on the 29th tomorrow. But even then, traders are pricing in a near certainty that after July there's going to be a rate hike. Now it doesn't say when, it doesn't say before December, it doesn't say before next year. It just says after July. Nobody, almost nobody, at least on Cauchy, is predicting any chance that the Fed is going to keep rates the same. Now, I've talked to some people, investors, economists, people who are gold investors. Not all of them agree with this kind of outlook. What's your stance?
Yeah, I think it's safe to say that I'm skeptical that we're going to have rate hikes. For a number of reasons. One is that the inflationary pressures we're getting aren't on the demand side of the economy; they're on the supply side. They're basically due to a oil price hike, a supply shock in oil, and that's obviously all war related. So temporary to one extent, but also on the supply side, and hiking rates don't help the supply side of inflationary pressures. They can only really exacerbate it by adding to the shortages that drive prices. So it's not demand driven on that side of the economy, where you would think that interest rate hikes would have a real helpful effect on dampening inflationary pressures. The other thing, frankly, is that Kevin Warsh was installed by Donald Trump specifically to institute an easier money policy to cut rates, if anything. So I don't think that he's going to hike rates. I think that his initial meeting and press conference afterwards, he really did a great job of emphasizing that the Fed was going to be very diligent on inflation. But then after that meeting, we didn't hear a peep out of Donald Trump. And he really doesn't hold his tongue very often, if at all. So the fact that he kept silent after Warsh stood up there and talked about how they were going to be so hawkish, that tells me that it was all performative, that was all pre-approved. And at the end of it, at bottom, the Fed is in a debt trap right now, or facing a debt trap where the cost to service the federal debt is only growing, and interest rates are only going to make that situation much, much worse. So they really can't afford to have higher rates, and Warsh wasn't put in office to do that.
Mm-hmm. Tell me more about this debt trap. What do you mean by debt trap? We can't just expand the balance sheet, print our way out of this?
Well, that's what they're going to do, frankly, but that won't solve the problem. Will only exacerbate the problem. Yeah, the federal debt is pushing on $40 trillion. The deficit is going to be over $3 trillion this year. And we're paying over $1.2 trillion in interest costs on the debt, just to service the debt. That debt service cost, is tremendously leveraged to the interest rate. I could show you figures, I could show you charts that I've been talking about for almost 10 years now. But it's all the chickens are coming home to roost. It's simple math. If you raise interest rates by a fraction from here, we dramatically increase the debt service costs, which in turn increases the deficit, which in turn increases the debt. So yeah, they will end up printing their way out of it, but it's not a strategy. It's more of a last resort. And the problem is the world is starting to realize this. We have the 10-year, which the Fed, of course, does not have as much control over, has been creeping upward. And it's not just the U.S. 10-year Treasury, but the 10-year yields on sovereign debt across the globe have been rising. And that is a function of the bond vigilantes coming out and demanding higher returns for the depreciating currencies that they see ahead. These currencies have to be depreciated to reduce this debt load. And the world is realizing that and demanding higher yields. Of course, higher yields only exacerbate the underlying problem.
Yes, economic theory tells us that debt ballooning will typically mean the host currency depreciating as well. But if the country raises interest rates, or if the 10-year naturally goes up by itself through market forces, not directly government intervention, wouldn't that put additional upward pressure on the dollar? In other words, wouldn't that balance out?
Well, the yields rise, and that makes the underlying currency in a normal situation more attractive. But if yields are rising because there's doubts about the ability of the sovereign to pay off those debts, or there's doubts about the sovereigns to be able to pay off those debts in currency that's worth anything near its current levels, then the tables are turned, as it were. That means that the currency, in this case the dollar, will have to be depreciated, and those who are bidding the yields higher know that, and that's precisely why the yields are rising.
What is the relationship, going back to my earlier introductory question, the relationship between real yields and gold?
In a negative real yield environment, gold tends to thrive, but gold makes its biggest moves when it's anticipating a negative real yield environment. Right now, real yields are positive if you use the government's inflation numbers and inflation expectations. But if you look at where inflation probably really is, then they are significantly negative. The yields are significantly negative. The bottom line is that a currency has to depreciate more quickly or at a higher rate than the interest rate on the federal debt in this kind of a situation, or the whole house of cards collapses and this debt trap grows and spirals out of control. So yields have to be, interest rates have to be lower than the rate of inflation. The currency has to depreciate more quickly. And that means that we'll have to have a negative real yield, negative real interest rates going forward in this kind of a debt trap. We're not there quite yet, but we are going there almost assuredly.
When governments around the world diversify away from the dollar, in other words, intensify de-dollarization, they turn to gold. Historically, that's been the answer. Is there a future where they turn to another fiat currency, Brien?
Well, all the developed nation fiat currencies are in the same boat in regard to debt and the need to depreciate those currencies. The U.S. is in a special situation because it is the global reserve currency, so it gets more leeway than other currencies. But still, the math is the math, and even the issuer of the global reserve currency can put itself in a situation, as it is right now, where the future is pretty bleak. The U.S. dollar is still the king of fiat currencies, and it's not necessarily because of the dozen aircraft carriers or even the network effect of so many dollars out there and so much dollar debt. It really is because of the rule of law. And the U.S., while there's a lot of reasons a lot of areas where you can improve, a lot of reasons to criticize the rule of law in the U.S., it's still the best out there. And so I don't see the yuan, I don't see the ruble, I don't see other currencies taking the global reserve currency crown off of the U.S. dollar. I do see gold, however, doing that, and doing that at an accelerating rate as we speak.
Okay, well, let's go back to the forecast of gold first. Before I get your forecast, I want to just show you what other people are thinking. Going back to prediction markets, most people on this particular trade, how high a gold price at the end of the year, most people are bullish, believing that there's a higher chance than 50% it's going to go above 4,300, above 4,400, 45, above 4,500, 37. It's interesting to note, though, that the average forecast for gold was higher in June than it is now. And if you look at news like this headline, for example, published July 8th, the Bank of America cuts 2026 average gold forecast, sees long-term upside, But in the short term, they're reducing their forecast by 14% by year end to 4,360 an ounce, citing a more hawkish U.S. Federal Reserve. Has anything fundamentally changed in the last month that have caused people to be not bearish, but less bullish than they were before?
Well, you have an end point on that. You know, the bet is where will the gold price be at the end of the year? So you have time decay working. So the longer that we have not recovered, the longer that it takes for us to finish this bottoming process and get back on an uptrend, the more likely it is that we're not going to see, you know, $4,500, $4,600, just because it's not that as much time left in the year.
Yes.
I think we're in a bottoming process. If we put in a couple of weeks, if we had $100 for the gold price over the next couple of weeks, you're going to see those numbers change dramatically, and sentiment change dramatically. My view is that we have to have the market come to realize that the Fed is not going to be hiking rates, and that we're not starting on a hawkish monetary policy, a tighter monetary policy over the long term. The earliest that I think that can become apparent to the market is probably September or October. Given that much time left in the year, you know, my views are that we're probably going to be in the $4,400 to $4,600 range by the end of the year. But you know, we could have more if we have the war end in that time frame. If we have the view on the Fed switch from being hawkish to actually being dovish, which I think is where we're going to end up, then we could even be a bit higher on the gold price. Let's remember that the only thing that stopped the gold price, or this furious rally that we had at the beginning of the year, the two factors that stopped that was Kevin Warsh's appointment and the war of Iran. Both of those are temporary situations. I think they're going to be resolved. And while that rally in January was going to burn itself out at some point because it was just too fast and furious, those two factors that really stopped that bull run, they're going to be gone probably by the end of this year, in my view.
Okay, well, before I buy into any asset, whether it be a stock or gold in this case that we're talking about, I like to see or understand who owns it and who controls the majority of the float if it's a stock, who owns most of the Bitcoin outstanding if we're talking about Bitcoin. And in this case, gold's a free market, but who moves the price is my question. Let's take January 30th as an example, the day when gold fell double digits in a single day. It wasn't just gold, it was silver, it was palladium, it was platinum, all falling on the same day. If it was different days staggered, we could argue, okay, well, they're just moving independently, but it seems to be a coordinated sell-off by institutional players. Do we have any notion or evidence to support any theories as to who these players may be and why they decided January 30th was the day to do it?
Yeah, we do. And as I mentioned before, the price is being set by Western traders right now. A lot of that is algorithmic trading. And you know, at that same time, in the end of January, we saw the rest of the markets, the stocks, everything else sell off. It was a bit of a liquidity vacuum, and it was caused by Kevin Warsh's appointment as chair of the Federal Reserve. And at bottom, that's what moves the markets right now. All of the risk assets, and gold has been lumped in with the rest of risk assets by these Western investors and traders. All risk assets are being bought and sold basis on Fed monetary policy and what the outlook is for that. So you have a supposedly hawkish Fed, everything gets sold off. You have a war that drives up the oil price, that leads to inflationary pressures, that leads to a hawkish Fed, so everything sells off. That's why gold is no longer considered, by Western investors at least, and these traders that are moving the market, it's not considered a safe haven asset, because in the view of the traders that set the price right now, Higher inflation means a hawkish Fed, which means tighter monetary policy, which means sell gold along with all the other risk assets. So that's who was selling it in January. The West was making the price, and frankly, the East was taking the price. Central banks were still buying. China has been buying even more eagerly on this price dip, and so they are taking advantage of the bargain levels that have been created by these Western investors.
If you go back to mainstream news, there's been debates as to whether or not gold is still a safe haven asset. This was a video interview. I didn't watch it. I'm not going to play it, but this is just a headline that's been circulating on BNN Bloomberg. Is gold still a safe haven asset? Understandably, people may ask this question after seeing a chart like this. If something drops by the order of 15% in a single day, 30% for silver, for example, but nobody's calling silver a safe haven asset. But if something is this volatile, how would you still make the argument that it is still a safe haven asset? I think is the debate that people are having. How would you answer this?
Yeah, it depends on how you define your terms. I think gold is no longer a safe haven trade. Probably never was a safe haven trade. But if you look over the longer term, if your time horizon extends to months and even years, then it is a safe haven investment. Because again, the fundamental factor is demand. The simple math demands that currencies be depreciated. So gold will advance against currency values across the board, fiat currency values across the board. In the meantime, there's going to be a lot of wiggles in the line, and that's where the traders come in. Again, they are lumping gold in with the rest of risk assets, and whatever central bank monetary policy, wherever the winds are blowing in regard to that determines what they're buying. We'll have, other factors like AI and the broader stock market and in tech stocks that will work against those trends, but more broadly speaking, it's the Fed continues to drive all of the risk assets, all of the markets, in fact. And that's why there's no such thing really in the short term as a safe haven trade.
Yeah. Okay, so Brien, I have here a long-term chart of gold. You alluded to the long-term strength of the gold price over the last 40, 50 years since the gold standard was abolished. We had a situation where the gold price massively beat out inflation over the last 50 years. Do you see a scenario? Let's say if I were to park my cash in gold and sleep on it for the next 40 years, if history repeats itself, I'd be pretty comfortable in preserving my wealth. That argument I understand. But do you see a new world order in which the world no longer needs gold anymore? What would be the scenario in which the last 50 years doesn't repeat in the next 50 years?
Yeah, I think we're headed toward a monetary reset across the board and fiat currencies across the board. If you look at that, again, this deficits in debt, and we've had over that time period that you're showing there, say 45 years of ever easier money, ever lower interest rates, and ever easier money encourages ever greater debt. So as the interest rates have trended ever lower over time, as more money has been created over time, then we've also had more debt created over time. The debt loads now have gotten to the point where they are simply unmanageable without significant further currency depreciation. So my view is we don't know, and no one's smart enough to know precisely what lies ahead. We're going to have more of these cycles where we'll have a liquidity event, liquidity vacuum, some type of a crisis like we had in 2008 with COVID, et cetera. And in each of these crises, the central banks have had to do much more to get the same impact on the markets. They took 4 to 5 years to get to zero interest rates, quantitative easing, and significant increase in the Fed balance sheet in 2008. In 2020, they did it in 4 to 5 days and a multiple of what they did before. So the next crisis, to get the same effect, because the patient has developed a tolerance for the drug, as it were, the dosage is going to have to be far greater. Does that eliminate, does that destroy whatever credibility is remaining in the dollar? I don't think so, but there's going to be another cycle after that. Each one of these cycles erodes the credibility of the dollar and other fiat currencies. Eventually, the only way to restore that credibility, I believe, is to reattach these currencies some way to gold. So I think that's the end game. I don't know when we get there. I don't know precisely how we're going to get there, but I think we can all recognize the trend. I think that's obvious. And if that's the trend, then you want to own gold and silver, the monetary metals, over the longer term.
Somebody wrote in a comment on another video of mine, they were debating what to do with their retirement accounts. Should have converted it to gold and silver and their mining stocks. You missed a generational move to double your retirement accounts. Then you don't have to pick out recessions or not. Just follow the money printing and debt monetization. Your response?
Yeah, I don't think anybody should be 100% into anything. Diversification means you're accepting mediocrity, but mediocre returns are still returns. I personally, I have my retirement account that goes into all of the standard, mainstream equities and the like. And I have my precious metals and mining stocks. Now, I have a real advantage in that sector because I know just about everybody in this sector. I have decades of a knowledge base, and I know how to play that sector. That's a real advantage. But other people can get a similar advantage in this sector because it's inefficient. You can outwork other people. You can do your homework. You can find what the market overlooks. As you periodically, it leaves gems, undervalued gems lying on the ground. So, you can gain an advantage in this sector, but that doesn't mean you should put 100% of your money in precious metals and mining stocks. Yeah, especially the mining stocks are a timing mechanism. They're a timing tool. The fact that Barrick Gold is trading for about the same share price as it did 20 years ago tells you that these are not buy and hold, build wealth over the long-term investments. When gold and silver are in catch-up modes like they are now, they can build wealth incredibly quickly. And that's when you need to be involved in this sector. And this is that time.
What else do you like in the commodity sector that you would also use the same words for? This is that time.
Yeah, David, I tell you, it's remarkable. We're fortunate in a lot of ways. We're fortunate in that we were able to invest in mining stocks and silver when gold was soaring, and we invest in those sectors at low levels. But we have a concurrent bull market across the board in commodities in general and in base metals even. Base metals, energy metals, battery metals, and the like. We have decades of underinvestment in the sector. We have a supply or demand curves that may be the steepest we have seen ever for a number of commodities, running smack dab into supply constraints when it takes 15 to 20 years to bring a discovery to an actual mine. The supply response, it just isn't there when we have to meet the demand curves that we have coming up. So we're going to have significant price responses across the board. I like copper. I like all of the battery metals. I like a number of the base metals. This is really a luxury that we have, and that we have two concurrent bull markets in the resource sector, the monetary metals and all of the other metals.
Is the world heading towards nuclear? Take a look at this piece of news from last week, 5 days ago. The U.S. signs a landmark nuclear deal with Saudi Arabia. The U.S. and Saudi Arabia have signed a deal that will allow the Gulf Kingdom to develop a civilian nuclear program. The deal is described as a peaceful nuclear cooperation agreement that will provide great access for American companies in the Saudi nuclear energy program by the U.S. Energy Department. Text from the deal has not been made public, but U.S. media report that it could allow Saudi Arabia to enrich uranium in the future, which can be used as fuel for power plants, but also to make nuclear bombs. This deal and many others like it, what is the signal for you about the future of energy demand?
Yeah, it's uranium. The uranium is the most certain and of these, the energy metal stories or the commodity stories out there. Outside of gold and silver as monetary metals, I think uranium is the one place where you can rest easy. You know that the demand curve is starting to steepen. The supply constraints are still obvious. And you have on top of what was already a compelling story, compelling supply demand story, you have over the last couple of years the whole AI data center story on top of that. There's no way that we can supply the energy necessary to build out those data centers without nuclear. And we have a renaissance in nuclear energy coming up in the small modular reactors. That's going to happen over the next 5 years. So, yeah, it is one of those stories. I take uranium and copper and I categorize those as set it and forget it commodity stories. The impact and the reaction won't be quick and immediate. It's not like finding a junior gold stock that makes a big discovery. But, buy some good names, put them aside, and check them in 3 to 5 years, and you'll be pleasantly surprised at what's happened.
I struggle to understand, however, Brien, why nuclear is the way of the future, but one country in particular has abandoned that future altogether. They must have done this for some reason. This is Germany. This is a chart that you've seen probably already dozens of times. Gross electricity generation from nuclear energy in Germany started off as being zero in 1965, peaked around the 1990s and early 2000s. Now it's back to zero. You have to wonder why a great industrial power would do this.
Yeah, and if you want to plot the chart of energy costs and it goes in the other direction over time, no, that's just stupid. Governments can be stupid, probably more so than people. It was an idiotic move. It was idiotic because it's a major transition in your energy mix. On one hand, it was a transition away from the one energy source that truly is green, and it put the country right in the crosshairs or made them extremely reliant on natural gas from Russia. So from every aspect, it was a bad move strategically across the board. It never underestimate the potential stupidity of governments. And this is a prime example in our time.
Was there a strategic reason for them to do this? Did they believe that no longer felt that it met the nation's objectives? You have to wonder if a nation that has experience doing this and no longer wants to do this, what can other countries learn from this experience besides, in your words, being stupid?
Well, it was part of the green movement, global warming, getting away from fossil fuels.
Isn't nuclear green?
Well, it is. That's the issue. But nuclear has the connotations of, Chernobyl, 3 Mile Island, Fukushima, all of that. And actually nuclear is one of the safer, it can be one of the safest energy sources out, and the necessary baseload energy that makes all of the alternative energy options even viable. So, yeah, nuclear has to be a part of the mix going forward.
I believe the irony here is that after nuclear was abandoned in Germany because it wasn't green enough, they're now back to producing more coal.
Yeah.
Their main source, I believe, is wind power, but coal is up there. Anyway, that aside, do you think there's an opportunity still in copper? A lot of people I've talked to are bullish on copper for the AI build out and data center build out reasons, as well as the ongoing global expansion of infrastructure and the greenification of the economy. But it's very expensive. It's $6 a pound.
Yeah, and it's going to get more expensive. Before you had all of the AI and even electrification of vehicles, if you had just a base load or base case for demand growth in copper, we were going to have extensive deficits, supply deficits going forward for many, many years. Now, on top of that, you had the electrification of vehicles, electrification or improvement of the electric grid across the world in developed countries, the installation of the electric grid in undeveloped countries. And you had the whole AI buildup that I've seen figures that 6% of the cost of an AI data center is pure copper, the cost of the copper in that data center. Copper is also a metal that you cannot innovate around, or we haven't figured out how to innovate around. You can't replace it with aluminum. You can't replace it with silver or gold, which are highly conductive as well. You need copper both in the transmission of electricity, but also in electric motors, the windings for electric motors. So you can't innovate around it, and it's getting increasingly more difficult to find and extract. So we need higher copper prices to bring projects to the market. And it takes a long time. It takes 15 to 20 years to bring a new copper project to market. Now, there are a lot of copper projects that have been identified out there that have not been economic at then prevalent or then existing copper prices, that with higher prices will be brought to market. But we're still talking about supply response times that are going to be a decade or so to bring these kinds of large scale projects to market. So that means we're going to get much higher prices. Copper is not cheap now, but we're going to have copper prices over $8 within a few years.
Is there anything in the commodities complex that you would say, if you hadn't bought in last year, you missed it? This run is over and just move on. Don't get in now. Anything that would fit that description?
I can't think of anything, frankly, and that, maybe diamonds, but for other reasons. But no. Oil is an emotional metal. Emotional commodity. It obviously fluctuates wildly depending on the geopolitical situation. But I think we're going to get back in oil to the level where we can produce it profitably. Companies can produce it profitably without putting too much of a pinch on economies. So yeah, I think it's a short-term play, not just necessarily a long-term play. And frankly, there are arguments in my view for much higher oil prices. There are also some valid arguments that prices are headed down once the geopolitical situation resolves itself.
And finally, let's talk about your philosophy on picking mining stocks, of which you're an expert. Let's focus on the juniors. Your first approach, somebody approaches you with, let's say, a proposition to buy a stock or private placement deal. What are some of the first questions you would ask this team?
Well, I look at the property first. The person who brought it to me obviously tells me a lot about it to begin with. That may be management. It may be somebody else that's in my network of spies, as it were, throughout the industry. So I have projects brought to me, companies brought to me all the time, every day. And I look at that if it's a trusted friend or colleague that I know knows what they're talking about, then I look into it a bit more. The project then is the biggest thing I look at. The target has to be large enough to move the needle. But this is a different market too. Historically, it's always been the case that you would discourage a junior from actually going into production or developing its own project. Today, with the gold price between $4,000 and $5,000, a junior company that is more of an explorer than a developer or producer can buy the expertise to get into production, can make a lot of mistakes, and still enjoy profit margins, operating margins like nothing we've ever seen in the history of mining for gold and silver. So it's a different market, and that's an aspect of it that's new. We say this time is different, is dangerous, but that's one of the reasons why this time really is different.
Well, thank you very much, Brien. Let's see how this time is different plays out. We'll follow you for more of your work. Where can we go to follow you, Brien?
You want to go to goldnewsletter.com. We have a free report, Investor's Guide to Gold, Silver, and Mining Stocks. Very extensive, comprehensive, objective, and it's for free. Just go to goldnewsletter.com to get it for free and get on our mailing list. New Orleans Investment Conference this fall, the end of October, here in New Orleans. It is the longest running investment event in the world. It is renowned for having the top roster of speakers in the world, and this year is no different. I urge people to go to neworleansconference.com and check out our speaker roster. You won't find anything else like it anywhere else, and this is the time to be in this sector.
Good. Thank you very much. We appreciate your time, Brien, and we'll put the links down below, so do check out Brien's work in the description there. Take care for now. We'll see you soon. Bye-bye.
Thanks, David.
And thanks for watching. Please do like and subscribe. Follow Brien in the links down below and use my code LIN, L-I-N, when you sign up to Kalshi. Remember, new users who use my code can get up to $500 if you trade $25. Link down below or scan the QR code here.